Let's review the developing a business with free cash flows of the firm, the FCFF model. As we discussed in the class, we have to focus on project free cash flows of 5-year projections and value the entire business, including the terminal value, which is horizontal value, and calculate the intrinsic value of the equity, the actual value of per share, and how much more or less is the intrinsic value than the market value of the equity. So in this section, we will finalize what would be the expected gain or loss on the common stock investment. And then the calculate EVA, ROE and ROE, the interest coverage ratios, the investment analysis part. So initial, the sales is, the period is 0. The initial sales is always a starting point. We want to grow this number with our expected growth rate on the projection assumption. So how much is? Okay, 261 is the recent fiscal year and the revenue. So 261. And then permanent growth rate after year 5. That is now we need to assumption 5%. I put the 5%, but anyway, you have to explain why 5%. For example, the tech industry average growth rate, the permanent growth rate is a little bit higher than the growth, the rate in GDP, like 3%. So 5%, for example. But anyway, you have to put the research back. Research the links or citations and explanation on it. And then WACC, we already calculate here. Everything you have to the link from the calculation procedure. And then we put some input variables. You may need more input variables, but to make it simple, I just use just 4 input variables. Now, the more importantly, we should make some storyline based on the research with citation or some links. Here, the sales growth every year. I started from minus 10% because of pandemic issues in the global, and 30% and maybe 30% recovered. So it's all about your assumption, but your assumptions should be explained in this cell as well as the water file, because the investor want to look at the old explanations of assumptions in a big picture on the water file, and then in a cell, each cell should explain why do you put this percentage, why do you stretch out this storytelling in terms of gross sales, in terms of the cost of revenue, in terms of the operating expense, all the assumptions that you required to explain where this get it, how this get it, why should be this number, based on your research and citation and the links. So cost of revenue for the first year, how to get it? Percentage of sales. So percentage of sales here divided by the revenue. Okay, so we found it. That explains the structure of the income statement of the Apple. Operating expense, where did you get it? Operating expense. Okay, here you go. 16 and 18 million. But I want to make the percentage of sales of this expense, operating expense. So divided by the revenue. So I got the 13%. The working capital is the current asset minus current liability. So open the parentheses. Then where did you get it? Okay, current asset, here you go. Plus accounts receivable, plus inventory, plus and other current assets. And minus current liability, 47, another revenue, minus other current liability. Sometimes you can put the short-term debt, but when you calculate the weighted average cost of capital, we assume that this short-term debt is part of the long-term debt that matures within 1 year. So we do not say this is working capital. But again, this is based on your assumption. and divided by the revenue, always percentage of revenue, so 18%. Then the fixed assets, how do you get it? Fixed asset is also percentage of sales. Come back to the WACC spreadsheet. Here you go. The fixed asset, which is property, plant, and equipment, divided by the revenue. So we got the percentage, 36%. Again, we will use these projection assumptions to make this operating cash flows and cash flows, net operating working capital. Cash flows and capital is the expenditure part. So that's why we need this. And then depreciation, I just put the hard number 15% because these are my assumptions. I assume that this Apple company has the property, plant, equipment that has the average maturity and useful life around 7.5 years, 7 years. So I put 1 minus 7.5%, around 50%. So 7.5 years, 7.5 years, for example. So around, or 1.7 years, 1 divided by 7 years, so around 15%. Then let's make a story based on this structure of the balance sheet and income statement. I assume that cost of revenue will be decreased the first year because of this the deflation under this pandemic. So a little bit pessimistic, but in terms of cost, it is good. So 56%, and then it's gonna be slowly better and better, and maybe will reach maybe before this pandemic. Operating expense will affect a lot. I think so, because the operating expense is comprised of the salary expense, selling expense, or the commissions, the transportations. Under this the deflation or pandemic, it's gonna be very the slow down, but later on it's gonna be recovered. But in order to tell this story, you have to research and then put this research data into this operating expense on the notes. And then the working capital is 10%, also decreased because the company tended to reduce the inventory under this recession. So 10% drop down, the huge drop down, but it's gonna be increased, slowly getting better. Okay, slowly getting better. 6%, for example. And then the fixed asset definitely will be decreased. I decreased like almost 10%. 10%. Why? Because no one company tried to expand their business under this pandemic issue, the global issue. But it's gonna be increased once the situation gets better. So I increased. What happened is, that's fine. 32%, and it's gonna be get better. The company slowly start to increase the investment, and then this depreciation, I will apply the same percentage because usually the depreciation percentage the company has is not much changing. The equipment, property, plant, they do not change that much. Next, the sales. Now we want to measure this sales from the first year, the base year. But this base year sales or the income statement information is not part of future cash flows, but it's good information to start your projection from year 1 to 5. So let's find this sales. Let's find this sales here. Where is the sales? Here we go. And then the cost of revenue. The same way, the operating expense should be the sum of this SG&A and SG&A and the R&D. And then EBIT, I think we got the same from there. We we got the same. So I just want to drag down, and then finally we got the net income 54, which is the same as the financial information, the income statement we collected from the 10K or any financial information. Then let's grow this. Let's grow this sales amount times 1 plus gross rate. And then let's stretch out. The cost of revenue is percentage of sales. From then on, this 56% times 234 sales amount. So let's stretch one more time. And the operating expense also same at 8% times the sales. And then let's stretch. And then EBIT, how to get it? Exactly that equation. It shows minus cost of revenue minus operating expense. So we got the EBIT. So like this, and the interest. Well, now we need the market value of debt times cost of debt. So where is the market value of debt? 130 times. We just assume that the cost of debt and the market value of debt is gonna be continuing. So I just want to keep this for 5 years, and then on the calculation, the EBIT minus interest. Now I got 81, and then stretch out. And then finally, the tax amount is 81 times, where is the tax rate? Okay, here we go. Then I want to fix this tax. When I drag to right, then all the tax is applied